Ladies and gentlemen, welcome to our presentation on Index Weather 101, where we introduce you to the fascinating world of the index weather philosophy. In the next few slides, we will delve into the concepts and strategies that have proven effective in predicting market downturns. Please feel free to post questions in the comment field below, and we will be happy to address them. Let's get straight to the point with a short summary. By adopting a systematic approach to investing, you have the potential to minimize your own mistakes and make more informed investment decisions. The Njord algorithm plays a crucial role in this process. It assesses the relationship between the market index and bonds, ultimately producing a numeric output. This number serves as a weather forecast for the financial market, indicating whether it's a sunny day for investors, positive trend, or if it's stormy weather ahead, negative trend. What's truly remarkable about the Njord algorithm is its track record. Backtests spanning all the way back to the 1970s, Standard & Poor 500 and the Nasdaq Composite demonstrates its effectiveness in market timing. Investors who have utilized this algorithm would have annual returns of 12% for Nasdaq and 9% for the S&P 500. Please note that these figures represent gross returns, and we'll explore the algorithm methodology in more detail as we progress through the presentation. So stay tuned for a deeper dive into the Njord algorithm and its investment insights. So why use a mechanical algorithmic system? Why should investors consider adopting a mechanical system for the decisions? Let's explore this question and understand why it's important to rely on a systematic approach. In the world of investing, there are several strategies that have shown promise over time. These include trend following, riding the wave of existing market trends to capitalize on momentum. Mean reversion, banking on the idea that asset prices will eventually revert to their historical average. Arbitrage, exploring price differentials between different markets or assets to make risk-free profits. Insider trading, accessing non-public information for trading advantage, and this is highly unethical and illegal. High-frequency trading, leveraging algorithms and technology for rapid and high-volume trading. But what can a retail investor, the small guy in the investment world, do? How can they effectively navigate this landscape? The answer lies in adopting a systematic approach like the Njord algorithm, which is accessible to all investors, regardless of their size. It provides a structured and data-driven way to make investment decisions, offering a level playing field. By utilizing a mechanical system, retail investors can gain an edge and make informed choices, just like the pros. Let's unravel the secrets behind the Njord algorithm, which plays a pivotal role in our journey to predict market trends. But first, why Njord? Well, Njord is the Norse god of weather, known for his ability to calm storms and seas. This is quite fitting for our algorithm, as it endeavors to navigate the tempestuous waters of financial markets. Now, let's dive into the algorithm itself. The Njord algorithm is a timing algorithm rooted in extensively researched techniques. It draws inspiration from trend following, with 90% of its strategy dedicated to following the prevailing momentum. And mean reversion. The remaining 10% focus on mean reversion, where it anticipates that asset prices will eventually revert to their historical averages. What makes Njord particularly intriguing is its reliance on the relationship between bonds and the market index. In broad strokes, when bonds rise, index tend to fall and vice versa. This relationship forms the cornerstone of Njord's predictive power. One of Njord's strengths lies in its simplicity. It boasts a minimal number of parameters in its code. As the saying goes, less is more, and the simplicity translates to robustness. The algorithm's minimalism makes it less prone to overfitting and more adaptable to various market conditions. Njord's efficiency isn't just theoretical, it has been rigorously tested. Backtesting data spanning from the start of 1970s until the present date validates its capabilities. If investors had the opportunity to use the Njord algorithm from the start of 1970s, they would have gotten annual returns exceeding 12% for Nasdaq and 9% for the Standard & Poor 500. Remarkably, this is achieved with fewer than 2 transactions per year, and even better results can be received when complemented with a savings account. So what's the purpose? It's reduce the big drawdowns. One of the central objectives of the Njord algorithm is to mitigate the impact of significant market downturns. By accurately identifying stormy weather, it helps investors avoid the perilous depths of large drawdowns that can erode portfolios. Easy to follow. Simplicity is key. The Njord algorithm simplifies the decision-making process by providing clear signals. When it detects sunny weather, it's a signal to buy, and when it senses stormy weather, it's a signal to sell. This straightforward approach makes it accessible to investors of all levels, reducing the number of transactions. Njord is designed to optimize trading activity, reducing the number of transactions. Fewer transactions translate to lower friction costs, including spreads, taxes, and fees. This efficiency enhances portfolio performance. By aligning these three key objectives, the Njord algorithm seeks to maximize gains for investors. It accomplishes this by safeguarding against significant losses, providing easily actionable signals, and minimizing transaction-related costs. Now, let's explore how easy it is to follow the Njord algorithm signals. On this slide, you will see three tables with columns. Index name, today CET, and that's Central European Time, indicating when the data was presented. Data point time, reflecting when the data was fetched from the internet, typically 2 or 3 days before Central European Time. Weather, sunny or stormy. Market, that's buy or sell. And Celsius, displaying temperature, where negative values suggest stormy weather and positive values signify favorable conditions. Here's what you need to know. Each new update shows the current weather. The algorithm provides regular updates, keeping you informed about the prevailing market conditions. In general, negative temperatures mean storm, and positive temperatures mean sunny. To simplify the decision making, think of it this way. When temperatures are a few degrees below zero, it's a signal that stormy weather is approaching. Conversely, when the temperatures are a few degrees above zero, it indicates sunny weather. So don't go out when it's stormy. In other words, when the algorithm signals storm weather, it's advisable to exercise caution and consider reducing your market exposure or even exiting position. This straightforward system ensures that you can easily follow the Njord algorithm's signal and make informed investment decisions. It's a user-friendly approach that empowers investors of all backgrounds to navigate the markets with confidence. I will shortly show you the backtests, but first it's important with a disclaimer alert. The results presented in our backtests are informative and insightful, but they come with certain limitations. Specifically, these results do not include the following factors. Taxes. Impact of taxes on returns is not accounted for in the presented figures. Ask and bid spread. The cost associated with buying at the ask price and selling at the bid price is not factored into these results. This spread can eat into gains and add to losses, although with very few transactions per year, this cost is negligible. Fees. Transaction fees and management fees are not included in the calculations. These fees can vary and have a substantial impact on overall results. Dividends. The results do not reflect the income generated through dividend payments. Dividends can be a significant source of return for investors. Inflation adjustment. Inflation, which erodes the purchasing power of money over time, is not considered in these backtests. Adjusting for inflation is crucial to assess the real value of returns. Now let's explore the Njord algorithm performance when applied to the Nasdaq composite. In this backtest we employed the following parameters. Using cash when not in market, the algorithm remains in cash when it doesn't detect a favorable market condition, i.e. the storm. Lead days. We have 3 days after receiving a signal before taking action. So this gets us to the annual returns. The annual return of this setup is 12.8%. The Njord algorithm demonstrates an impressive annual return. It's 65% in the market and 35% outside of the market. If you look at the picture, you see the lines that goes horizontally. That's when you're out of the market. That is that you have cash instead of an ETF. We have an average of 1.3 transactions per year. The algorithm maintains a low turnover rate, minimizing transaction costs. To better understand the graph on the right side in this slide, it is essential to note that the y-axis uses a logarithmic scale. A logarithmic scale is employed to visualize percentage returns more effectively. On this scale, equal distances on the vertical axis represent equal percentage changes. On the x-axis, we have the time in years, spanning from 1971 to August 2023. Within the graph, you find two datasets. The blue line represents the performance of the Njord algorithm when applied to the Nasdaq composite. Both series start at a value of 100. The Njord algorithm concludes at approximately 50,000%, showcasing its impressive performance. The orange line represents the performance of the Nasdaq Composite Index. It too starts at a value of 100 and concludes at approximately 9,000%. These results vividly illustrate the significant outperformance of the Njord algorithm compared to the Nasdaq Composite Index. This backtest underscores the algorithm's potential to enhance investment returns over the long time. And this would be the diagram when using a normal chart. Now let's continue our exploration of the Njord and Nasdaq performance with some intriguing comparisons. First of all, we have the year-on-year comparison to the left. In this chart, we plotted a rolling 251-day comparison, allowing us to gauge the Njord's performance over time. Notice the most significant drop during the IT bubble in the early 2000s, with a mild 25% decline. It was a turbulent time for investors. And the second one, from peak to lowest valley. In this second chart, we depicted Njord's drawdown, a measure of how much an investment drops from its peak value. Njord faced a downturn of approximately 34% during the early 2000s, a challenging period indeed. However, the Nasdaq Composite experienced a far more substantial downturn, plummeting by a whopping 76%. What's even more remarkable is the recovery time. While it took nearly 15 years for the Nasdaq Composite to return to its previous peak, Njord rebounded in just a few months. Njord's other notable drawdowns hover around the 20% mark, showcasing its ability to weather market storms with resilience. These comparisons shed light on the Njord algorithm's potential to mitigate losses during turbulent times and recover swiftly, ultimately enhancing your investment. This time we're adding a new twist by incorporating a savings account into the mix. In this scenario, we put our cash to work when we're not in the market, but instead of holding it as a cash, we parked it in a savings account. The data for the savings account in this example comes from the American Federal Fund's effective rate. Here's the parameters. We're stashing the cash in a savings account when the market is unhappy, and we get interest for that. We have 3 days lead time, so after the data point is made, we're waiting 3 days just to see that it works. We have an annual return of 16.9% or around 330,000% in 50 years. We're 68% in the market and 32% outside of the market. We average around 2.6 transactions per year. With the introduction of a savings account, our strategy involves an average of 2.6 transactions per year, slightly higher than the previous scenario. And this is not inflation adjusted. The Sharpe ratio is a ratio of risk-adjusted return, and it stands at a commendable 1.18%. And the volatility is around 0.21. As you can see, the Njord algorithm in combination with the savings account propels our returns to extraordinary levels. With Njord's guidance, we achieved an astonishing growth of over 300,000%. In the words of the brilliant Albert Einstein, compound interest is the eighth wonder of the world. Who understands it earns it, and he who doesn't pays it. These results demonstrate the incredible potential of harnessing the magic of exponential growth. And here's a familiar chart as well. It's the drawdown for the timing model and the year-on-year development. So here we are looking at the drawdown chart for Nasdaq. You can see the red circle, it's the biggest drawdown. It's around 0.33 or 34. And you can also see the yellow circles, which highlights the savings account gains. We also have a year-on-year timing model, and it's almost never under 1 sometimes, but it's not more than maybe 20% or 15% at most. Let's take a closer look at the Nasdaq buying dates since the turn of the millennium. In the table displayed, you will find a comprehensive list of buying and selling transactions spanning from the year 2000 and onward. Over this 23-year period, a total of 31 transactions have occurred. This table provides a valuable historical perspective on the Njord's algorithm's actions in response to market conditions. It highlights the algorithm's ability to identify opportune moments to enter the market and capitalize on positive trends, while also indicating when it's prudent to step aside during stormy weather. Analyzing these buying dates can offer insights into the algorithm's decision-making process and its effectiveness in optimizing investment returns. Now, let's shift our focus to the Njord's algorithm performance when applied to the Standard & Poor's 500 index. Similar to our previous analysis with Nasdaq, we concluded a backtest to assess its effectiveness with the Standard & Poor 500. The key parameters are almost the same as before. We use cash when not in market. We have 3 days from the data point. With that, we have an annual return of 9.11%. We're 65% in the market and 35% out of the market. And here we have an average of 1.4 transactions per year. Here we have a graph. Within the graph you will see 2 data series. The blue line represents the performance of the Njord algorithm when applied to the Standard & Poor 500 index. Both series start at a value of 100. The Njord algorithm concludes at approximately 10,000%, showcasing its impressive performance. The orange line represents the performance of the Standard & Poor index. It starts at the value of 100 and concludes at approximately 5,000. These results clearly illustrate the significant outperformance of the Njord algorithm compared to the Standard & Poor 500 index. This backtest reaffirms the algorithm's potential to enhance investment returns of the long term. And here we have the year-on-year development and the current drawdown. You can see that the drawdown for Standard & Poor 500 using Njord is around 20 to 21%, much less than the Nasdaq version. Let's take a look at the performance of various European indexes until the August 24, 2023. It's important to note that these numbers represent gross returns, meaning that they do not account for taxes, fees, or gains from dividends. In the table, we have listed following European index along with their respective data. We have DAX, SSMI, that's Switzerland, and we have France at CAC 40. We have Eurozone for Euronext 100. We have the Swedish OMX S30. We have the Norwegian index, and we have Stoxx 550. You can see that most of these gains are approximately double of the index, and we have a good annual returns for most of the index, and much better than if you just would stay in the index. The transactions per year ranges from 1.2 to 1.7. Here's the Asian index until August 23. Taiwan, Hang Seng, Nikkei, Shanghai Composite, and South Korean Kospi. We have an annual return from 3.4% to 7.9%, and an average transaction from 1.3 to 1.9. What's next? Updates are currently rolled out periodically on the algorithm, but soon we're aiming for daily updates. Subscribe if you're interested in staying ahead with the latest updates. Thank you very much for listening.